there are trade-offs in terms of energy, because we're going to need oil and gas for years to come, and getting to less reliance on oil and gas is going to take some other, mining of other metals that are not helpful. So we have trade-offs, and it depends on how we want to get there.
Laura, you are Professor of Finance at the University of Texas, and I wanted to say thank you so much for joining us today.
Thank you. I'm pleased to be here.
Now, there's a couple of things I think we can talk about today, and I know you're expert on a few things, but I wanted to start on the topic of ESG. And if you don't mind, let's go back to sort of pre-COVID years, because I do remember a lot of the buzz in around 2018, 2019, going into 2020. It was very much about people having to have much more of an ESG initiative, and investors were certainly going that way, and it was important to recognize environmental social governance when you're looking at corporates or corporations to invest in. So if you could just take us on a bit of a journey over the last few years about how you feel the focus on ESG investing has gone from then to kind of where it is now.
I'll go back even a little bit further.
Yeah.
I started teaching about ESG investing in 2011, one of the first classes to MBAs and undergraduates, and it was very much a niche investment strategy then. By 2018, 2019, it had become mainstream, and they were receiving ESG funds, ESG ETFs were receiving lots of flows, and positive flows month after month. And they're still receiving positive flows month after month. But there was great demand, and a lot of the demand was coming from millennials and from women. It was like 70% of millennials said they wanted to invest in ESG, and over 70% of women.
I think everyone in the world agrees that we need to be transitioning towards a greener planet. It's just, is the road paved with copper, so to speak? Like, do we need to mine more metals to build these very large electric grids to transfer, the way the world, digests its energy on electric grids? I mean, how do you feel about that whole concept?
There are trade-offs in terms of energy, because we're going to need oil and gas for years to come, even with all the efforts that are being done. And getting to less reliance on oil and gas is going to take some other mining of other metals that are not helpful. So we have trade-offs, and it depends on how we want to get there.
As well as I understand it, it's not so much from brown to green, it's from brown to light brown to even lighter brown to light green to slightly darker green to green, and that's just what we're going to have to do, and that's the process we're going through. And then we have like the Ukrainian war that is causing even more issues with energy. I've seen you talk before a little bit about how COVID really changed so many things. Could you talk a little bit about how ESG as a concept changed over the COVID years?
So one of the main things that happened, there's some research that shows that when the stock market dove in March 2020, that companies that had high environmental ratings and social ratings actually were very resilient, and their stock prices didn't dive as much as others. And part of that is, I believe, because investors were looking for companies that, particularly on the social aspect, were treating their employees well. And I think that's one thing that the pandemic did. It brought up the S, because the governance part of ESG has long been important. The environmental part has gotten more important in recent years, or last decade, I guess. And then the S part has been slowly growing. The problem is, for ES and G is the definition, because we have two approaches. One is people's values and preferences, which I think of as ESG values, and the other is people's financial value, which I think of as ESG value. And so they're approaching it from different perspectives.
What about the larger corporations out there, the Googles and the Facebooks and the Amazons? They are clearly sort of pioneers of in the world. Are there levels of ESG at acceptable levels now?
I think it depends on how you're doing the measurement, who's doing the measurement, and what people's preferences are. I think all of the large companies are getting a lot of pressure from clients, customers, employees, and investors. And that's not going to change. Even if ESG is becoming political in the U.S., they're still going to have employees, customers that want to see them do better on the environmental, social parts of their business.
Have we got to a level where we've got standardized measurements of ESG? Are we close to that?
No.
Okay.
Well, no.
It feels like that might be step one, though.
Let me step back. There are a number of third-party raters.
Okay.
If you look at the ratings, there's a important study out of MIT where they've shown that across these third-party rating agencies that the correlations range from like 38% to 60%. So there's a lot of difference. I think that's okay because it depends on what the analysts think about the company. And if we think about sell-side analysts, they look at companies differently. They're not like credit ratings. It's not as clear how the E, S, and G should be measured.
I mean, when you look at sell-side analysts, some have price targets of $50 and some have price targets of $150. At some level, it's subjective. But I guess at least having something there which holds these companies accountable is a positive step.
Yes, and there's a big difference between Europe and the U.S. in terms of what has to be disclosed.
Can you explain that in a little more detail?
In Europe, there are stricter disclosure laws. For example, the UK has a mandatory carbon reporting law. The U.S. doesn't have that. And the SEC has come out with a new proposal, but there's a lot of debate about this proposal. And
what's the pushback there?
The pushback is that it's going to be too costly to the companies, that investors don't need this information. And I think one of the biggest pushbacks is that the SEC doesn't have the authority unless it has financial implications. And there's a pushback on how severe the financial implications are.
Are there US companies out there that are volunteering this information, or is it, as we stand, we just don't have a sort of set standardized way of reporting it?
No, there are companies that are volunteering the information, and if you go to the Carbon Disclosure Project, which gathers the information, there are more and more companies that are voluntarily providing their carbon emissions. There's more than carbon emissions, though, that we need to understand about the companies.
Yeah, I just always feel like carbon emissions are the sort of headline number. So what does the US, in your opinion, need to be doing to try and play catch up with Europe?
I think having reasonable disclosure standards, I think is important. The SEC proposal is 500 pages, and I don't know how appropriate all of their disclosures are. I can't say one way or the other, but I think we do need more standardized disclosure. And I think one positive part of that is that the Value Reporting Foundation, which has brought together different sustainable accounting standards under one roof, is helping to educate companies on what would be beneficial for them to report.
How do you feel that sort of the goal of heading towards a net zero carbon world looks like in the rest of the world?
Well, if you look at China and India, and their carbon emissions, they've been the fastest growing, and they argue that, wait a minute, the U.S. and Europe was able to develop.
They had their years of the glory years.
Right. We should have our opportunity. But the other thing about, for example, if you look at the Chinese emissions and you look at how much is for their own domestic consumption and how much is for U.S. and Europe consumption, their relative emissions goes down because a lot of it is coming to the U.S. and Europe.
What are sort of the main areas of focus that you're looking to teach people nowadays?
What I teach my students is you should look at ESG from a financial economics perspective. And what does it help us do? It helps us understand the environmental risk, it helps us understand the social risk, and it helps us understand the governance risk. To me, that's what's important for the students to understand in an investments class.
Yeah.
Is what kind of risk exposures are we able to understand more deeply by looking at each of these ESG separately.
But so I wanted to go back then. If we've got students and you're trying to embed this idea that when you're looking at corporations, whether it's an investment or to go and work there, you need to be aware of their ESG focus at the company. How is it possible to really sort of rate the ESG value at certain companies if we haven't got these standardized ways of measuring ES and G? It still seems quite subjective.
There is subjectivity, but there's subjectivity in lots of investments.
Right, sure.
Right? So I think, one of the things is...
But for example, like, gender, like the number of, the ratio of men to women, or, the pay of men to women, or I mean, are those sort of things that would be relatively easy to implement?
Some of them, but then you have to differentiate what are these different types of jobs, and that becomes difficult to compare across if they're actually in different types of jobs. But there are some companies that have really worked at trying to differentiate this, and what's the gender pay gap. I do have some research on the gender pay gap for executives across the world, and so there it's a much better for comparison, and we find that it's very much related to the cultural environments that exist in the different countries.
You mentioned just earlier that, which I thought was very interesting, that some of the more ESG friendly companies did better during the market correction in March of 2020. Can you talk a bit about, do you know how those companies are faring now, and do you feel that was a wake-up call to many other companies to try and protect themselves from any other kind of economic correction?
In terms of looking at investor demand, which in some sense gives us information about how companies are doing, if you look at the flows into ESG, they've been in Europe, they've been very steady, very strong, even this last quarter. The flows into ESG in the US were lower the first quarter, but they were still positive. So ESG funds and ETFs are still garnering lots of flows, and so companies in some sense want to position themselves where investors view them as being well established in terms of what they're doing for the environment, the social, and the governance.
Now, in terms of investor attitude and behavior and biases, I'm going to segue a little bit to another topic I know you speak about, which is genetics and inheritability of genetics and biases that investors have when looking at markets. So could you talk a little bit, at least generally to begin with, about your work in that area?
With my co-authors Rick Seiss and Harry Turtle, we were able to get data on over 5,000 individuals in the U.S., and that data included that they had given DNA swabs, so it included some information about their genetics, and in particular these polygenic scores, which are proclivities for certain traits, and so we looked at cognition, personality, health, and body type, and found that those were very much related to their financial decision making.
Can you elaborate with some of the conclusions, or?
Yeah, and they're intuitive.
Okay.
So if you have a PGS score, which means that you have a genetic propensity for educational attainment or cognition, then you tend to be less risk averse. You tend to be more realistic on your return beliefs, so you have less bias in your return beliefs, and you're more likely to participate in the stock market.
Right.
On the other hand, if you have a genetic propensity toward being depressed or toward being anxious, neurotic, then you are more likely to be more risk averse, have more pessimistic return beliefs, and you're less likely to invest in the stock market.
This sounds fascinating. I mean, I've always thought that your sort of environment would play a bigger role in terms of your natural behavior when it came to being risky or not. But to know that there's some like genetic element to it sounds rather groundbreaking to me. How are you sort of looking to sort of take that research forward?
Well, we're trying to understand more now, in particular, about the biased return beliefs, because people in general are much more pessimistic in their return beliefs than if you look at the last 90 years of stock market history. And so one of the things that can be done with this is to better educate people, to better counsel people on making their retirement decisions.
I've read reports that certain companies like McKinsey who like insist on the Myers-Briggs test because they do feel that your personality is a big part of how you're going to perform at a certain company. And from what you're saying, it's just interesting that certain people will be naturally more better investors, more interested investors, and some will be risk averse. So at some point, do you think we'll be able to just take a test as a teenager about how we should be investing our retirement, for our retirement?
I think that the test would provide you with information on how you should think about investing for the retirement. Because because if you find out, okay, I am more anxious, which is making me more risk averse, maybe I should think more about how to invest the money.
Yeah.
And one of the things that's important about this is stock market participation is a big factor in wealth inequality. And so if we can understand more why people won't invest in the stock market, then that can help reduce wealth inequality.
What are the characteristics of people who just do not believe or won't invest in the stock market?
Well, according to the genetics, and then there's also research just on the traits. People who are more sociable are more likely to invest in the stock market.
I can see that.
And again, education is important. General cognition is important. Health is important. Life experiences.
Yeah.
So if you had a time where you had really poor returns in the stock market, you may be less likely to invest in the stock market.
I think I'd like to take this test myself. I think in my head, I think I'm very pro-risk, but secretly I'm quite risk averse. Well, this has been fascinating, Laura. Thank you very much for taking the time to chat today. It's been really interesting.
Thank you very much. It's been fun.